All right. Money Monday is starting soon. 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 All right, everybody. We're back at the whiteboard tonight. Give me 1 second while I share this video to my personal Facebook page. Share now. Public. I want this information to be public. Perfect. All right, and it is live, so we can see. I can see if anybody has any questions. Hi, everybody. We're back at the whiteboard again tonight. Hopefully, the internet continues to work as we keep going tonight. Thank you so much for joining me for another episode of Money Monday. If at any point in time during this Money Monday, as always, you have a question, drop it in the comments. I'm seeing one right now. I'm going to have to go away to read it. It's time. Yes, Brian, it is time. Thanks for joining me. Today we have some it's a fun topic. It's about risky stock moves. These are moves that I don't really recommend people do, but they're words that are bandied about and people talk about them and you should know exactly what people are talking about them. Today, we're specifically talking about shorting stocks and buying stocks on margin. Again, you hear these things all the time. You probably heard, especially in 2008, you probably heard about people shorting the stock market in the movie The Big Short. What does it actually mean to short a stock? Why are both of these strategies so risky and dangerous? We're going to be going into all of that today. Before we get into it, I want to thank everybody who came out, all our clients who came out to our previous book club. We got another book club coming up in not this Wednesday, but next Wednesday. Looking forward to seeing you there. And our next webinar, our next online event, we just had it months earlier this afternoon. We have next ones coming up on December 16th at 5 p.m. Mountain Time, 7 p.m. Eastern. Looking forward to seeing you all there. I'm going to post a link in the comments here so you can register for that. Again, at any point in time, if you have any questions, feel free to comment below and let's get into this. First, we're going to talk about shorting stocks. What does it mean to short a stock? And why is it called shorting stocks? You're going to hear, if you types of positions, and you can either be short a stock or long a stock. If you're long, that means you bought it, you believe in it, it's regular buying a stock. If you short a stock, that means you don't think that stock is going to be doing well, so you short the stock. The idea is you're going to be making money as let's say this is the stock market. You're going to be making money as the stock goes down. Economists were wondering, how can we make money off of this motion? A lot of money making in stocks happens from the motion that's happening there. Quality is not great, but you can still see that it was a downward trajectory right there. So let's find a way to make money off of that. Well, I'm going to make a little bigger here. Let's say we think a stock is going to do this. It's going to head generally downward. How do we make money off of this? Somebody realized, well, it would be great if we owned the stock up here, sold it, or if we could sell basically money for the stock up here where it's at its highest is basically the way that the thought process goes. But you don't have any of that stock. So what do we do? Well, let's say this is you over here. You're this smiley face. And let's say you have a friend over here. This smiley face. This smiley face has the stocks that you want. So what you do is you borrow those stocks from this person. This person, your friend, gives you the stocks. Now you own the stocks up here. Again, you think it's going to go down. So what do? You sell stock. Let's say up here, selling stocks, and there it's worth $100,000 total. You gain that money. Later, something happened. Prediction true, which again, we believe in the efficient market hypothesis. So the likelihood of that happening is very low. Let's just say your prediction's true. Down here, the stock starts going down, and it actually stocks that you used to have end up being worth only $50,000. It loses value by half. What happened, what you do then is you sold the stocks up here. You got $100,000. That $100,000, you go down here and you buy that same number of stocks for $50,000, give them back. But what that means is you also get $50,000 in this scenario. You keep that profit in the difference between here. This becomes dangerous because if the amount of risk yourself to is massive, say that you're wrong. Let's say that the stocks don't do that. Let's say they actually, starts to recover and the company actually starts to do well. Suddenly you sold the stocks down here for 100,000. You got to give those same stocks back, but stocks are now worth 150,000 up here. What that means is you got to pay $150,000 in order to get your friend back his shares. Because remember, you're just borrowing those shares from him. Like, put it a different way, in a little bit of a more tangible way. Let's say you borrowed your buddy's car. Yeah? Let's say you borrowed their car. Boop. Boop. You borrowed and you went out and you sold it. You sold it for $10,000. Think, oh, I'm going to be able to get this same car back later on in just a little bit for $5,000. Let's say, you think that the same exact type of car and everything about it is the same down there, and it's only $5,000. So if you sell this one for $10,000, you back in a couple days, $5,000, you've pocketed $5,000 and give your buddy the car. But what happens is that something happens like in today's car market, and suddenly that car isn't $5,000, it's $50,000. It's the car back. So you're going to be paying $5 in order to make him whole. The other reason that another reason is so risky is that there's usually some sort of a fee that you have to pay to be able to stock, and that's why most normal people aren't. It's not something that's available to them. You got to be a big institutional investor, have a lot of money, being an accredited investor in order to be able to make use of this tool, because you're borrowing millions of shares at a time. You're also paying a percentage. Basically, think of it like if you were borrowing your buddy's car. Hey, give me your car. I'll give you $20 a day to borrow a car. But he says, okay, great. He's getting some money. He's going to get his car back at the end. The companies that hold the stocks are thinking the same way. So they are lending out, that's $100,000 worth of stock, and they're still making some money. And that's why we have these two people, happy you and happy other investor. Let me make it a little bigger. That's why we have these two people, happy you, happy other investor. And that's why both people are interested in this. You think you're going to be able to make money because you're going to be able to buy those shares back later for less. This investor here, the shares because they think it's going to go up, or they wouldn't be in the long position. And also, you're going to be giving them a little bit of money in order to be able to borrow those shares. That's so you're not only exposing yourself to a lot of risk, but you're also exposing yourself to an expense that comes with shorting the stocks. And that's why it becomes very difficult to do so successfully. There's been some books that have been written, and I read some studies that talk about how shorting stocks help keep markets efficient, and that's why it's important to make shorting stocks available to people and to institutions, because it helps keep everything efficient, because people who believe the stocks are going to go down have a way to continue making that money. So that is short stocks. Again, you have the unlimited risk, because the stock going up could just keep going up and up and up and up and up. And so you basically unlimited while you're also paying some money. Let's talk about margin loans. You might have heard of this. Margin I kind of gave it there. What is buying a stock on? Buying it with credit, buying it with loaned money. If you open up a margin account, you're going to have to put up it's 50 to start out. So it's out 50-50. You can buy 50%, your share 50, and then the other 50% broker provides you to buy stocks. It is a loan. And that's very important to keep in mind, because you're going to be paying interest on that loan. The reason why it becomes appealing to people is because if you're suddenly able to borrow money and make you think you have some really good deals. So let's say the interest rate you're paying is maybe 9%, and you think that you're going to be able to get some sort of deal that's going to give a 12% return. Suddenly, the difference between these two, the interest rate and the return you're making, is called leverage. You're making a profit off of that loan, which is fantastic if you're successful. Again, efficient market hypothesis says you're not going to be successful all the time. Very difficult to be successful, and you're suddenly exposing yourself to a lot of risk. So again, you're paying interest on this, and interest is basically the prime rate, depending on on the brokerage you're using. It might be 7.5, and then might be less if you have a lower balance. Might be more. Might be if you have a higher balance. Might be more of a low balance, something like that. But you're paying interest. That's something you have to pay. On top of which, there's something called a margin maintenance. So you can't drop below the legal limit right now is 25%. 25% of the total of the holdings can't be it can't be lower than 25% of your own money that you put forward. So that means if, let's say, stocks start losing money, things are going great, suddenly you can't back up all of the loans that you're borrowing. Let's say, so this means that 25% equals cash in the account, your cash, and then this will mean 75% is a loan, is basically a credit card you're using to buy these stocks. If it goes higher than this, they do what's called margin call. So you need more cash to look back to 50, whatever it might be. Brokers have one rule. And if you can't, then they're going to start liquidating positions in order to be able to actually meet these ratios that they have to keep in place. So this is a huge amount of risk, because suddenly you're going to be forced to take to have some money issues, some cash flow issues, if the stock doesn't keep moving the way that you think it's going to be. Enormous amount of risk, on top of which you're going to be paying a real rate the whole time that you're doing this. So you're taking on risk and you're paying for the privilege to do so. Other ways to take on risk that actually gives you return in exchange. This is a very high risk, moderately high reward situation. The vast majority of people who end up trying to borrow a margin don't do well. There have been some stories that came out during tax season last year. People who didn't realize they had a margin account. They were just buying on margin. Tax day came around and they didn't have the cash for the margin call, and also they didn't realize that they had incurred so many capital gains taxes. So people really put themselves in a pit by investing with money that they didn't even have. Warren Buffett has a story where it used to be, I forget Warren Buffett's current partner, but it used to be three of them, three guys, Warren Buffett and his current partner, I want to say it's Chuck something. They kept investing in their specific way, which is pretty safely, but using different factors. The profitability factor was basically what Warren Buffett uses, and then their business partner started buying positions on margin, and at a point They called him on, they had a margin call he couldn't afford, and he had to sell all Berkshire Hathaway stock to Warren Buffett in order to cover it. And that's why there's 2 billionaires that are heading Berkshire Hathaway, and there's not 3, because one person got into a situation with margin by investing on margin. Super high risk. And the number one rule of investing, which you're going to hear us always say, number one rule of investing is don't lose money. Number one rule. Best way to get rich, don't lose money. So if you find yourself in a situation where people are trying to get you to short stocks or get you to buy stocks on margin, there's other less risky ways that will mean that you won't lose money. Remember, both of these highly risky avenues, you have to pay for the right to take on that risk. There's ways to take on risk where you get paid as opposed to the other way around. That's it for today. I can still see that the internet connection is not great here. I have no idea why that's happening. Somebody knows anybody, tell them to get in touch with me. That's definitely something that's happened frequently lately. But thank you all much for joining me for an episode of Money Monday. Again, I'm Henry. I'm your friend in finance. I hope you'll have a wonderful Thanksgiving. Have a wonderful week. I look forward to seeing you next week. Bye.